Hello, and welcome back to another series of video lectures. This series of videos are going to deal with, or will deal with, Chapter 4. And Chapter 4 talks about understanding financial statements. So up to this point, we've done a lot within the accounting cycle, right? We saw how to prepare journal entries, right, using the debits and the credits. We saw how to conduct or prepare our adjusting entries. We saw how to prepare our closing entries. We saw how to prepare financial reports, and then we saw how to do our closing entries. So in this video, in this chapter rather, we're going to take a closer look at those financial statements, right? Back in, I want to say it was chapter 1 or chapter 2, we kind of did a high level overview of these are the financial statements. Here's the balance sheet. Actually, no, that was chapter 3. We went through, all the financial statements, the order in which we prepare them, and kind of gave you an idea of what they look like, right? So in this chapter, we're going to dive a little deeper and look at each of those financial statements. So let's get started, and we're going to look at the classified balance sheet. So ultimately, at the end of the day, your ultimate goal is to be able to put together a classified balance sheet. But in order to do that, you have to understand, what is the classified balance sheet? What does it look like? What are its characteristics? So that's what we're going to go through in this video. So just like the we'll just call it the regular balance sheet, okay, that we talked about last chapter. The classified balance sheet does the same thing, right? Meaning it still presents the accounting equation. We still have our assets, we still have our liabilities, we still have our stockholders' equity. But with the classified balance sheet, we break down our assets and we break down our liabilities into subcategories. So, for example, for the assets, we're going to separate them into current assets and long-term assets. Same thing with liabilities. We're going to break them down into current liabilities and long-term liabilities. And, well, stockholders' equity is still stockholders' equity. We're not breaking that down any at all. But the reason why we do this, the reason why we break things down and create these subgroupings, is it allows us, or allows analysts, to take a look at the balance sheet and make some decisions on the company. Okay, so we're going to, as we go through this chapter, we're going to get into some things like solvency ratios, liquidity ratios, and that's what this classified balance sheet really helps us do. So let's break down each of the subcategories. We're going to break down current assets, long-term assets, current liabilities, long-term liabilities. So in this slide here, we have current assets, okay? Current assets include let me rephrase that. Current assets are any asset that the company has that is either going to be used or converted into cash within the normal operating cycle or 1 year, whichever's longer, okay? So examples of current assets: cash, right? Cash is, well, it's cash. It's already converted to cash. That is a current asset. Short-term investments, okay? What do we mean by short-term investments? Well, just like you or I might invest in, we might have some extra, well, you guys are all college students, maybe not, but hopefully you have, a couple extra bucks laying around, right? Well, what are you going to do with that? Well, maybe you put it in a bank, right? Maybe you put it in a savings account to get some interest, or maybe you go to the bank and buy a short-term CD to get some interest, right? Corporations do the same thing. If they have cash on hand that maybe they don't have a specific use for, guess what? They're not just going to sit on that cash, right? They're going to make their cash work for them. So what they're going to do is they're going to invest it, right? Maybe they invest in CDs. Maybe they buy commercial paper. The key here is that the corporation, or the corporation is going to invest in short-term investments. These are investments that are either going to be converted into cash within the year or the operating cycle, whichever's longer, okay? We already discussed accounts receivable, right? We know accounts receivable to the corporation stands as, or it exhibits a right to collect cash, right? Well, the corporation believes that those accounts receivable are going to be converted into cash within the year or the operating cycle, whichever's longer. So they believe that if they extend credit to someone, meaning I'm going to perform a service on account, or I'm going to sell a product on account, those customers are going to pay those customers are going to fulfill their obligation to pay us, okay? Inventory. We always feel that inventory is going to be converted into cash, within a year of the operating cycle. And we might have some other current assets as well. This is kind of like our catch-all. Anything current that we believe is going to be converted into cash within the year of the operating cycle, we'll just lump it under there, okay? So the point is, we got to know what current assets are. I think we beat that to death, right? Kept repeating what is a current asset. We identified we got there 5 or 6 current assets. So what we need to recognize here is that there is an order of listing current assets: cash, short-term investments, AR, inventory, other current assets. We list these on the balance sheet in order of liquidity, meaning cash is going to be converted to cash first because it already is. Those short-term investments going to be converted into cash before the accounts receivable. Well, guess what? We're going to collect our accounts receivable before we turn our inventory into cash, right? So as we go down the line, we say that each of these items is a little less liquid than the item before it, okay? Now we look at long-term assets, okay? These are assets that the company really does not expect to convert these assets into cash during the normal operating cycle or the year, whichever's longer, okay? So these long-term assets we call our revenue producing assets, okay? That means that we intend to use these assets to generate revenue. So things like property, plant, and equipment, things like intangible assets, any other long-term asset that we have, okay? So think about it from this standpoint. We make widgets. What's a widget? It's a fictional product. Little joke if anybody's ever seen Back to School. Anyways, think of equipment, right? Equipment is an asset to us, to the corporation. It is a resource that we control. What do we do with that equipment? Well, we use it to generate revenue. We use it to produce products, which in turn we will then sell, okay? So long-term assets, those are our revenue producing assets. So PP&E, call it property, plant, and equipment, pretty easy, right? Any long-term asset that we use to generate revenue that falls under PP&E are things like land, building, equipment, vehicles, furnishings, anything like that. Let's say that, I'm trying to think of a good example here. I'm drawing a blank. But let's just say that McDonald's, all right? So McDonald's has land, right? Sure they do, right? The corporation buys land, they build a McDonald's building on it, okay? Well, so we got land, we have building. Everything that goes into McDonald's, right? The fryers, the grills, cash registers, whatever. That's all equipment that we use to generate revenue, okay? The furnishings, right? That would be things like maybe like the tables and the chairs and the booths and, stuff, the playground, right? That would be examples of furnishings. So intangible assets, these are assets that do not have any physical substance, right? These are things like brand names, copyrights, patents, trademarks, right? So we need to think about this really. So a company has a copyright. or a patent, okay? That means that they are protected by law, that nobody else can use their patent or their copyright or their trademark to make revenue, right? Think of Nike, right? Or I learned a good one a couple semesters ago in a managerial class, the Louis Vuittons, right? The red bottom shoes, right? So I'm going to assume that Louis Vuitton has a copyright on the red bottom that they paint their shoes. So I can't go to Payless, buy a bunch of women's shoes, spray paint the bottom of them red, and pass them off as Louis Vuitton, right? That would be a copyright infringement or a patent infringement or even a trademark, depending on how they sought to get protection under the law. So just an example, these intangible assets, even though they lack physical presence, do actually help the company generate money, okay? So now we get into current liabilities, right? We know what a liability is. Liabilities are obligations. So we're just going to break these down, these obligations, into current or long-term, okay? So liabilities that are going to be settled within the normal operating cycle or the year of a company, or a year, whichever's longer, those are current liabilities, okay? So we have things like accounts payable. We already saw what accounts payable are, right? Accrued expenses. We just got done talking about the accrual basis of accounting. So we know what accrued expenses are. Deferred revenue, right? We know what deferred revenue is. Any short-term loans, those are all examples of current liabilities. Why? Because we expect each of these obligations to be settled within the year or the operating cycle, whichever's longer. Okay? Then we have our long-term liabilities, right? Long-term liabilities are debt obligations that are not going to be settled or do not come due within the normal operating cycle or year, whichever's longer, okay? So these are our long-term IOUs, right? Long-term notes payable, bonds payable. Those are examples of long-term liabilities, right? Think of a corporation. If any of you guys have a mortgage or even a car loan, that could be an example of a long-term liability, right? Are you going to pay that car off within a year or the operating cycle, whichever's longer? Probably not, right? You're not going to pay your mortgage off within a year. So that's a long-term liability, right? There's X amount that's due way out into the future, okay? Past the year. Stockholders' equity does not really change, right? Remember, stockholders' equity, we said stockholders' equity is that residual ownership interest, right? So we said basically that stockholders' equity are the owner's claims against the assets, right? And we need to think about it in a sense of, how do we finance our assets, right? How do we finance our operation? Well, there's two ways, right? We as owners can contribute money, or the company can borrow money. So basically, when we say that stockholders' equity is that residual ownership or that residual ownership interest, what we mean is whatever is left of the assets after liabilities have been paid off, that's what we have. Okay, that's our owner's equity. That's that residual interest. Nothing really changed here as far as the two major categories within stockholders' equity. We're still looking at common stock. Remember, common stock is the amount that investors have invested, or the amount that stockholders have invested in the company. Then we have the retained earnings, right? Remember, we said retained earnings is that cumulative net income of the business that hasn't been distributed to stockholders' equity. And I apologize, my dogs are going nuts. So if you remember in chapter 3, we said, we have retained earnings, and we said we want to think of retained earnings as that bucket, right? That bucket that holds all the net income, okay? So that's what we mean, or that's what this means when it says cumulative net income of the business, right? We haven't paid any of this net income or this cumulative earnings out as dividends yet. The company retains it so we can use it to reinvest in the business. Okay. So when we're looking at the balance sheet, and we got to figure out, okay, how are we going to put this thing together, right? So we're looking at the presentation of the balance sheet. We have two formats we can use. We can use account form and we can use report form. Well, we're going to use the report form we're going to see here in a second, okay? So when we're looking at the account form, right, that's left to right, right? Account form says we put all the assets on the left, put the liabilities and the stockholders' equity on the right. That's the account form, or the account form classification, I guess, if you will, the balance sheet. The report form actually goes top to bottom. So first we list our assets, then we list our liability, and then we list stockholders' equity. The examples that we've looked at so far, and again, I'm going off memory, I believe have all been report formats. Okay, so nothing new here, right? We looked at the balance sheet last chapter, right? And we went through, hey, here's how we prepare the balance sheet. Here's how it's linked with statement of stockholders' equity and cash flow and all that. So notice the form of the classified balance sheet, right? We still have our heading up top, right? We have, I guess this is Apple Company, so we're always going to have the company name, balance sheet. That's the name of the financial statement. And then in this one, notice we have 2 years, 2014 and 2013. This is a comparative balance sheet, okay? A lot of times companies will provide investors, or in their financial statements, they'll do comparative balance sheets, being able to show 2 years. That's important, especially for analytical purposes. We need 2 years. So that's just one takeaway. This is a comparative balance sheet. We have 2 years. But notice what we have here. We have current assets, a category, current assets, and then we list all our current assets, which are listed in order of liquidity. Then we have our total current assets. We see in 2014, our total current assets were 68,000, or probably, I think this is in millions, 68,531,000. Then we have our long-term assets, and we list those out, okay? Then we have our total asset section. In order to get that, remember, we need to add total current assets with total long-term assets. Then we end up with our, or once we get our total assets, we go ahead and calculate liabilities, stockholders' equity, right? We list out our current liabilities, and we list these in order of not liquidity, but we list these in order in which we feel they're going to come due, right? Accounts payable always first, and we just lump in other current liabilities. We have total current liabilities. We have long-term liabilities. We list those. Then we have our stockholders' equity. And notice that the balance sheet balances. Total assets equal total liabilities plus stockholders' equity. Okay? Okay, so which of the following is not a subgroup on a classified balance sheet? Well, hopefully you look at this and you think, well, yeah, current liabilities, that's definitely a subcategory. So is long-term assets. Stockholders' equity, yep, that shows up on the balance sheet. Net sales, net sales. I'm not too sure what that is yet, but it says sales. Sales is equivalent with revenue. That probably shows up on the income statement. So C is the answer. That is not a subgroup of a classified balance sheet. So, we're going to stop now because I think I droned on enough. When we come back in our next video, we're going to look at the multi-step and the single-step income statement. So tune back in for that one. Should be good times.